We do get an FOMC meeting next week that could be a catalyst for another move up in the price of gold. You know, the Fed is expected to cut rates yet again. The biggest moves in any bull market, and this is not just for gold, but in general, when you're in a bull market, the biggest moves are down. Just like in a bear market, the biggest moves are up. And that's because the market is trying to fool people into thinking that either the bull market is over or the bear market is over. And in the case of gold, it's a bull market, and these sharp corrections are designed to scare out the weaker players, people who may have just come into the market more recently, and just kind of get rid of them, get rid of the dead weight, the excess baggage before we move up to new highs.
Gold's bull market remains strong and unbroken despite the recent pullback, something many mistakenly view as weakness. In reality, sharp corrections are a natural part of any long-term rally, serving to shake out short-term traders and test investor conviction before the next move higher. Historically, every major bull run has seen sudden drops that catch investors off guard, transferring wealth from weak hands to strong ones. Today, central banks continue to buy gold at record levels while reducing their holdings of U.S. treasuries, signaling waning confidence in the dollar's long-term stability. This steady accumulation forms the foundation of a broader monetary shift that mainstream analysts often misinterpret as simple profit-taking. Veteran economist Peter Schiff, founder of Euro-Pacific Asset Management, emphasizes that this correction is not the end of the rally but a healthy reset. With inflation still climbing, rate cuts approaching, and gold holding firm above the $4,000 mark, he cautions that those waiting on the sidelines risk missing the next powerful surge. As Schiff puts it, these dips are not warnings, they're opportunities to accumulate before the next wave of institutional buying begins. Now let's move to the highlights from Peter Schiff's interview. Before we continue, don't forget to subscribe and turn on the notification bell for time.
It could be a very short-term negative in that we got a correction, right? A bunch of people rushed in, and now we get a correction. And that's probably the last couple of weeks, not the last 4 months, because it wasn't until very recently that gold started rising at an accelerated pace. But I do think that the fact that we finally have some inflows into gold ETFs and that they are significant, to me, does indicate that investors are finally getting interested in gold. Now, they're not interested enough, and there's not enough of them who have gotten interested. But now, after having no interest whatsoever, they're finally starting to recognize that they should buy gold. And I think that that is a good sign, because I don't think that the money that came into ETFs in the last few months is done. That now that gold has pulled back from 43 and change back to 4,100, that whatever interest was prompted is now gone. No, I think that's the tip of the iceberg. We have a lot of money that's going to be following up. Now, yes, there may have been some short-term leverage speculators that got burned because they came in late and they got surprised by a big correction. That's possible. But all of this is normal in a bull market. And as I've been pointing out, the biggest moves in any bull market, and this is not just for gold, but in general, when you're in a bull market, the biggest moves are down. Just like in a bear market, the biggest moves are up. And that's because the market is trying to fool people into thinking that either the bull market is over or the bear market is over. And in the case of gold, it's a bull market, and these sharp corrections are designed to scare out the weaker players, people who may have just come into the market more recently, and just kind of get rid of them, get rid of the dead weight, the excess baggage before we move up to new highs. But the media acts like, oh, this is the top, right? Get out. If this was the top, nobody would know. I mean, that's how tops are generally made, or bottoms. Like, you don't really realize that you're at the top until you're a long way down, right? The market, they don't ring a bell at the top or the bottom. And so you don't get this big drop that says, aha, the gold bull market is over. No, these big drops like that are a sign that the bull market is alive and well. It just has this correction. And of course, the market was getting overbought. Of course, not overowned. Overbought is a technical term, because very few investors own gold. Gold ownership among institutional investors and retail investors is historically low. That's why a lot more money is going to come in. But again, what's also very significant is that the central bank buying is not even close to ending. They are ongoing buyers. They are buying for a reason. They need to increase their gold reserves. They need to decrease their US dollar reserves. And so this is going to happen regardless of the price of gold, right? They are buying, and they're not buying their gold to turn around and sell it. They're buying their gold to hold it in reserve to provide backing for their own currency, backing that they can no longer really have with the US dollar or US treasuries, given the likely decline in the value of the dollar and treasuries. And so they are divesting. And so this is going to continue, but the investor interest, I think, is going to continue to pick up in gold and silver. So I don't think the highs that were established last week and earlier this week, those are not the highs. Those are just a temporary high. I would be surprised if we didn't take those highs out before the end of the year. We could easily move quite a bit higher than those highs. You know, we're not getting a lot of economic news because of the government shutdown. We do get an FOMC meeting next week that could be a catalyst for another move up in the price of gold. You know, the Fed is expected to cut rates yet again. And that is despite the news that we got today. You know, we finally got some government economic data. I guess they forced them to do this even though we're in a shutdown. They released earlier this morning the CPI numbers for September. And consumer prices rose 0.3 on the month, which was a bit below the consensus of 0.4. But the more significant number is that year over year, CPI is up 3%. Now, that's 0.1% hotter than the prior month, slightly below the 3.1% that analysts had expected. But what's more significant is the sequential number going up. So we were at 2.9. We didn't go down from 2.9. We went up to 3. Now, remember, the Fed claims that its target is 2. So if your target is 2, and in the last month, you moved up from 2.9 to 3, so you're 50% above target and you're headed in the wrong direction, what would you expect the Fed's next move to be? Well, it should be a hike, right? If inflation is 50% above target and rising, and the stock market is at a record high. By the way, all three of the major stock market indexes, the S&P, the Dow, and the NASDAQ, hit new record highs today. In fact, the Dow today closed for the first time ever above 47,000, excuse me. Again, this is a nominal high, not adjusted for inflation or the price of gold. But you've got record high stock prices. You've got $4,100 gold. You've got inflation 50% above target and rising. Right? The Fed should hike. Yet the Fed is about to cut. Right? And that's one of the reasons, right, that the markets are where they are, including gold, that the Fed is going to do the wrong thing. So we'll see how the market reacts. In the meantime, take advantage of this pullback in the price of gold. Gold was as high as almost 4,400. We're now down closer to 4,100. Buy some. Silver, I think now buying it below 50 is a great buy because I don't think it will be below 50 for long. And I do believe that 50 will ultimately be the support, even though we're below 50 now. That was the double top. We've taken it out. We've now pulled back. I think the next move will probably catapult it much higher than 50. So you can still buy silver right now. So go to Schiff Gold. Don't just watch the YouTube videos on the Schiff Gold YouTube channel. Go to Schiff Gold. And more importantly, take advantage of a 15% correction in gold and silver stocks. Gold is looking great with a $4,000 floor. These miners are going to be literally printing money. The reaction to the Newmont news today, I think, is just a buying opportunity in Newmont, in the rest of the sector. When people are afraid and they're selling their stocks, that's the time to add to your positions, buying more. If you didn't have a big enough position, if you were worried that you missed it, right? You were watching these mining stocks really run and you were regretting the fact that you didn't put more money in. Well, don't regret it now. You can put the money in. The market has given you an opportunity. Don't squander it.
Gold's recent correction tells a very different story from what the mainstream narrative portrays. The market didn't retreat from the $4,000 level. It corrected to it, establishing that price as a new structural floor rather than a point of resistance. This marks a major milestone in gold's long-term bull cycle, signaling increasing stability above psychological levels that once triggered sharp sell-offs. However, while gold consolidates at these stronger levels, mining stocks have been hit hard. Indexes like GDX and GDXJ have dropped sharply, even as the sector reports record-breaking earnings. This disconnect highlights a broader misunderstanding among investors and financial media, who continue to interpret gold's movement through an outdated lens of skepticism instead of recognizing the structural transformation underway. Major producers are posting earnings that have doubled year over year, yet sentiment remains cautious, a classic sign of an early-stage bull market, not a speculative frenzy. As global trust in fiat currencies continues to weaken, gold's resilience above $4,000 looks less like a market peak and more like the foundation for a much larger revaluation ahead. Let's return to the interview.
I think the most significant aspect of the gold correction is that we didn't correct from 4,000. We corrected to 4,000, meaning that the correction started well above 4,000. It's not like we ran into resistance at 4,000, which is what a lot of people would expect at a big round number like that. I mean, typically, psychologically, you get resistance. We had it at $2,000 gold. We had it at $3,000 gold, though not quite as much as we had at 2,000. But a lot of people would have expected that 4,000 to be some type of resistance that, could cause a pullback, and it may take a little while for the market to muscle through 4,000. Instead, we went through it like a hot knife through butter. Yes, we had a correction, but we fell down to 4,000. 4,000 now looks like the floor for the price of silver. Now, instead of being emboldened by that, because if 4,000 is the new floor for gold, that is great news for the gold mining companies. But you wouldn't know that by looking at what happened to those stocks. The GDX is now down 14.5% from its high last week, and the GDXJ is down 15.5%, and pretty much every silver stock is in a bear market, right? Down more than 20%, even though silver is at 48.5, which is a very high price for silver. And the fact that it was able to get through 50 all the way up almost to 55, I think should be encouraging news for silver stock buyers, because it shows that 50 isn't the ceiling anymore. We went through 50. And yes, we're back below it now, but I doubt we'll stay below it for long. Now, getting back, though, to gold and 4,000, I think 4,000 is the new 3,000. And if you recall, when we got above $3,000 gold, we did dip below it a couple of times, but we didn't stay below it very long. It really was the floor. The same thing is probably going to happen with 4,000. Now, I wouldn't be surprised if the market went back below 4,000, especially since it came so close this week at 4,016. Now, maybe that was the low. Maybe this is the end of the correction. But it's also very possible that that's not the low, that the market retests that number and maybe goes a little lower than that in order to shake out some of the speculators who may be, buying it now and putting some stops below that low, or maybe below 4,000, hoping that it won't go down there, and trying to get, kind of a low risk trade where I'm buying gold at 4,100, or maybe they got it a little lower and I'll get out if it gets below 4,000 or something like that. So there could be some people trying to do that, and, they may get stopped out. Then again, they may not. I don't know, but I don't even care, because I think that if we do go back below 4,000, it's only going to be very briefly and mainly probably just to flush out those stops. And then the market will come back up. So I think we're headed a lot higher. I think the fact that gold went above 4,000 is a very bullish sign. But what's also very bullish to me is how the media, the financial media in particular, is covering gold's rally and, more important, its decline, because they're treating it like this is the end of some kind of speculative mania. In fact, I was watching on CNBC today, and they reported some news that came out from the inflows to GLD. And there were very substantial inflows finally into GLD over the last, 4 months. And that contrasts sharply with the earlier part of the year and all of last year, where we had massive outflows out of GLD. Now, the way they covered it was, this probably shows you that it's the top of a mania because the investors were chasing gold at the highs, as if we've seen the highs. We haven't seen the highs, but according to CNBC, maybe we have, because the investors got suckered into the market and bought the highs. Now, that's very different than the way they covered news last year, when we had huge inflows into Bitcoin ETFs. They didn't hold that out as evidence of the end of a mania, of the individual investor being dumb enough to buy the highs of Bitcoin. The way they covered that was as a positive. They said, well, this just shows that interest in Bitcoin is spreading, right? Now you have more investor interest in Bitcoin, and so it's a good thing. And so money going into Bitcoin ETFs was a positive for Bitcoin, but somehow it's a negative for gold. Gold is not in a bubble, and that investors remain skeptical and pessimistic and fearful, right? In a bubble, investors throw caution to the wind, and it's greed that rules the trade. But in the gold trade, it's still dominated by fear. And a good example is the reaction to Newmont's earnings, which were released, I think, last night. So after yesterday's close, but first time U.S. investors could trade Newmont stock in the U.S. because it also trades in Australia, and so it was down last night in Australia. But in the U.S., the first trading was this morning, and Newmont opened down about 7%, despite the fact that it announced record earnings and record revenue. In fact, earnings doubled, more than doubled from a year ago. So again, the price of gold isn't double, but their earnings doubled. And they beat estimates too. But instead of focusing on the good news, investors focused on what they perceived to be the bad news. Right now, in a normal bull market, that's longer going, where you have more optimism. Investors focus on the good news and ignore the bad news. But earlier in the bull market, when there's more skepticism, the bad news seems to get all the coverage. So what was the bad news in the Newmont earnings? Well, Newmont warned that in the current quarter, Q4, their cash flow will be impacted by some severance payments that they're making and some other costs related to construction of some, mining operations, a water facility. I forget the exact expenditures. But those expenditures, unlike the severance were just one time. A Q4 event, the severance payments will be made, and then that'll be it. But the other expenses could be recurring for several quarters, I forget, maybe a year or two, until this thing is completed, in which case then, they get additional production. So they focused, I think, investors on the fact that, wait a minute, there's going to be some negatives in Q4, and so let's sell the stock. But they ignore the fact that gold prices are already much higher, even with the pullback now, than the price they realized in Q3. And probably the extra income they're going to earn from higher gold prices is going to more than offset these costs. So earnings are going to go up. They're not going to go down.
The recent correction in gold has uncovered a deeper truth about this bull market. Stability has taken the place of speculation. What was once a ceiling at $4,000 has now become a solid foundation, showing that the market is maturing even as skepticism lingers. The sell-off in mining stocks and the pessimistic media coverage are classic signs of an early-stage bull cycle. Many investors remain distracted by short-term noise, overlooking the long-term setup taking shape. When gold consistently holds its floor through volatility, it signals that institutional confidence, not hype, is quietly fueling the rally. What we're seeing isn't exhaustion, it's accumulation. Gold's fundamentals are aligning with record central bank purchases, strong mining earnings, and a growing loss of trust in fiat currencies. With inflation still running high and monetary policy remaining loose, the foundation for a new all-time high is already being built. These corrections aren't red flags. They're opportunities for those who understand the cycle to strengthen their positions before the next major move higher. This is how wealth quietly transfers hands, when fear blinds most investors to the opportunity right in front of them. Share your thoughts on this analysis in the comments, and if you found the discussion valuable, don't forget to like, subscribe, and turn on notifications for future updates.